Welcome to the Deep Dive. Today, we're jumping right into the midday market action from Friday, August 1st, 2025. It looks pretty brutal out there. We're trying to figure out why Wall Street is seeing such a sharp sell-off, and crucially, what this dual shock everyone's talking about really means for you.
Yeah, it's a serious situation. I mean, what we're seeing isn't just a wobble. It feels more like the core assumptions, the narratives holding up the market, they've just crumbled today. We're in a moment where everyone's forced to fundamentally rethink the economic picture.
Okay, let's quantify that a bit. How bad is the damage right now, midday?
Well, the S&P 500 is down about 1.5%. Pretty steep.
Wiped out the month's gains, then.
Essentially, yes.
Yep.
The Dow Jones has shed over 570 points. That's around 1.3%. It's extending its losses. And the NASDAQ composite, that's leading the way down, really, tumbling more than 2.3%.
Ouch.
Yeah, the high-growth names are getting hit particularly hard. And like you said, it's not just one or two bad headlines. It really feels like the bedrock beliefs supporting stock prices have just disintegrated.
So what are the core drivers, this dual shock? Let's unpack the first one.
Right. The first big fault line here is that July jobs report. And honestly, it was stunningly weak. Just 73,000 jobs added. That's way, way below what people were forecasting.
73,000. Wow.
Yeah, and maybe even worse were the downward revisions. They slashed 258,000 jobs for the May and June numbers combined.
258,000 revised away? That's huge.
It is. And you saw the U.S. unemployment rate tick up again to 4.2%. That's the third month in a row it's climbed. So, those cracks are really showing in the labor market now. It's not looking quite so resilient anymore.
Okay, so that's shock number one. And then hitting today, the second punch, these new trade tariffs are officially live.
Exactly. No more waiting, no grace periods. Commerce Secretary Letnick made that very clear. They are in effect now.
And the scope is pretty wide, isn't it?
Oh, incredibly broad. We're talking 66 countries affected. Duties range from 10% up to over 40%. Think about it, 35% on Canadian imports, 25% on goods coming in from India. It's significant.
And companies must be scrambling.
Absolutely. Ford, just as one example, they're already projecting about a $3 billion hit just from these duties.
Okay, so jobs weak, tariffs hit. How's the market actually reacting beyond the headline stock indexes? What about, say, the bond market?
Well, you're seeing a classic flight to safety. The VIX index, Wall Street's fear gauge, it surged over 38% today. That's its highest point in nearly 6 weeks. Fear is definitely up.
Right.
And that nervousness is sending investors piling into bonds. So Treasury yields have plunged dramatically. The 10-year yield dropped down to 4.24%. The 2-year yield plummeted even harder, down to 3.75%.
Wow, quite a drop. So what does that signal about the Fed? I mean, they've been sounding pretty hawkish lately.
Well, it seems the bond market is basically ignoring them right now.
Huh, yeah.
Yeah, it's really quite something. The odds of a September rate cut, based on Fed funds futures, they've skyrocketed to 81.4%.
81%. So the market's basically demanding a cut.
It's certainly pricing it in very aggressively. The bond market is effectively dictating Fed policy expectations at this point.
Interesting. So how does this connect to what's happening with different types of stocks, the sectors?
We're seeing, a tectonic shift, you could call it. Consumer discretionary, non-essential spending, that sector is getting hammered the most, down 3.4%.
And I saw Amazon was down quite a bit.
Exactly. Amazon's down about 7%, which is really dragging that sector lower. It shows you, right? Weak jobs plus tariffs.
People worry about spending. Makes sense.
Precisely. But look at the flip side. Defensive sectors, consumer staples, actually up slightly, about 0.38%. Healthcare is trading almost flat.
So investors are running for cover.
That's the signal, yeah. They're ditching growth-oriented stuff and hunkering down in areas they see as safer, more stable. It's a defensive playbook kicking in.
And you really see this divergence at the individual company level too, right? The bar for success seems incredibly high now.
Oh, absolutely. Take Reddit, for example. They reported Q2 earnings. Just a blowout quarter. Revenue up 78%, a surprise profit.
And the stock.
Up over 20%.
Yeah.
So exceptional performance gets rewarded even now.
But if you miss?
If you miss, it's brutal. Look at Floorcourt, the engineering firm. Yeah. Stock plunged over 20% today.
Why?
They missed their forecasts and slashed their guidance, pointing to big cost overruns on projects. So yeah, no room for error.
So as we head into the final stretch of trading today, what's the bottom line for you listening? It feels like a real battle.
It really is. You got this immediate sharp fear about an economic slowdown clashing with this almost Pavlovian response from the market.
Hoping the Fed will ride to the rescue again.
Exactly, that long-conditioned hope for a bailout. So the big question heading into the close and into next week is, which force wins out?
Yeah.
Will that high expectation for a September rate cut act as a kind of floor, a psychological safety net for the market? Or does the bad news is actually bad news idea take hold? Does the market decide the economic damage is just too real, too severe, and a future rate cut won't be enough to fix it?
So how today finishes could be a pretty big clue for next week.
A very crucial indicator for you, yes. Watch that close carefully.